This video starts Principles of Accounting, Chapter 2. In Chapter 2, we're going to talk more about the business transactions and financial statements that occur in accounting. Business transactions are the first thing that we do in accounting. So one of the things that the main job components of accounting is journalizing business transactions. That's what Chapter 2 is going to focus on. So we use source documents. Source documents are things like canceled checks and receipts. We look at these source documents and we decide what this transaction happened and how it affects the accounting equation. Then we record those events in a journal. Once we've recorded those events in a journal, we post that information to a ledger account. Then we prepare and analyze the trial balance and financial statements. So source documents are bills, sales receipts, invoices, purchase orders, checks, payroll records, bank statements, any variety of thing that describes what is happening within our business. And our account is where we record all of the increases and decreases in those assets, liabilities, equity accounts, revenues, and expenses. The general ledger is a list of all of the accounts that our company uses. We have asset accounts, liability accounts, and equity accounts that make up our accounting equation. We've already talked about a few of these accounts in Chapter 1. There's examples in these pictures about what can be asset accounts, what are things that end up in liability accounts, and items in equity accounts. The first couple of chapters, we're going to focus on asset accounts. We'll also do some transactions for liability accounts and equity accounts in Chapter 2 and 3, but when we dig deeper into those accounts, we're going to start with the asset accounts. So what are the asset accounts? Remember from Chapter 1, assets are anything that we own that we use for our operations. So cash, accounts receivable, notes receivable, prepaid accounts, supplies, equipment, buildings, land, just to name a few. Liabilities are things that we owe to other people. Accounts payable is when we buy supplies on credit or buy items on credit for our business and we owe suppliers. Accrued liabilities are when we accrue things to be paid later. One of the most common accrued liabilities is wages payable, and this is because employees work for us and they earn payroll salary that we don't pay them until later. So we have to accrue that in our accounting records that we owe them for work that they've already done that we have to pay eventually. We might pay them twice a month, we might pay them once a month, we might pay them weekly. Notes payable are loans. So we've taken a loan, we've taken a mortgage, those items. Unearned revenue is revenue that we've been promised from some kind of contract, but we haven't performed the service yet. So say we're a web design company and a customer comes to us and they want a website and they give us money, tell us everything they want, they put a deposit down on their website and the rest of the money. That deposit becomes unearned revenue. We can't record it as a revenue in an equity account until we've actually provided the service. If you remember that rule from Chapter 1, that revenue recognition policy that says that we both have to have provided the service and received money for it. So in unearned revenue, we were paid the money, but we haven't provided the service yet. Equity accounts are revenues and expenses, common stock, and dividends. With the expanded accounting equation, you can see that we have the equity accounts underneath with the common stock, dividends, revenues, and expenses. The ledger is our collection of all of the accounts and their balances in the entire accounting system. The chart of accounts, as shown here, is just a list of all accounts and the identifying number for each account. So in our accounting records or in our ledger, we'll have a number on each account to keep them separate from each other. So in this example, you can see that all assets are listed in the 100s and all liabilities in the 200s, common stock, retained earnings and dividends in the 300s, revenues in the 400s, and expenses in the 600s. A T account is a ledger account. That's where we record our transactions to keep track of what is happening within our account. On a T account, we'll have the account title, and then we have the left side of account, which is a debit, and the right side of the account is a credit. We use double entry accounting. So remember from chapter 1 when we were talking about the accounting equation, that every transaction affects two things. And that's how our accounting equation balances. So when we're looking at our T accounts, we're going to record those items into our T accounts. So we need to remember how we change our T accounts for assets, liabilities, and equity. With assets, we increase on the debit side. So an asset account has a normal debit balance. Means that if there's a positive amount in that account, it's on the debit side. When we take money out of an asset account, we credit that T account. The opposite is true for liabilities. On liabilities, we have a debit for decreases, but we credit the increases. So the normal balance in a liability account is the credit side. For equity accounts, we credit for the increases and we debit for the decreases. Now there are some exceptions to the rule for the equity accounts. And we see that in this expanded accounting equation where we expand out the equity section. So for dividends and expenses, things that decrease our equity account, that has a normal debit balance. So we think about how it affects that kind of account. So for assets, the credit side decreases assets and the debit side increases them. So the debit side is the normal side. Then equity, common stock, we have credit for increases for common stock and revenues, and debit for increases for dividends and expenses. And liabilities, we increase on the credit side. That's the normal balance of the account. This is an example of a cash account. So we have that we've recorded information. So you can see this side is the debit side. We've recorded that we received $30,000 in cash, we earned revenue, and then we paid out different amounts. At the end of the accounting period, we balance out those accounts. So you see here we added $36,100 to this account during the month, and we subtracted $31,300. So at the end of the month, our balance is $4,800 on the debit side. So when we're journaling and posting these transactions, first we receive our source document. Then we look at that source document and analyze where it goes in the accounting equation. Next, we record the journal entry into the general journal, and then we post that entry to the ledger. The ledger is where we have those T accounts. This is an example of a journal. So in a journal, we'll have the transaction date, the titles of the affected accounts, the dollar amounts of debit and credits, and then a transaction explanation of what that item was for. So we can see in this first transaction here, occurring on December 1st, 2009, we received an investment by the owner of $30,000 in cash in exchange for common stock. In a general journal, we indent the second line. So we write all of the debits first, and then we indent all of the credits in a journal entry. On December 2nd, we purchased supplies for cash. So we had an increase in supplies, we debit the supplies account, and we decrease our cash, where we credit the cash account. This is an example of a balance account column. So in a computerized accounting system, the ledger account would look like this instead of like a T account. So in this example, this is another copy of that cash account that we saw in a T account on a few lines ago. We received $3,000 and $30,000 in cash. We paid out $2,500 for supplies. We keep a running balance here on the side. When we post journal entries, we take the information from the journal entry and put it in the corresponding account. We also record the date, how much. We'll have a some kind of indicator of what journal entry this corresponded to. So we have that this was the general journal entry 1. We have account 101 here, account 307 here. And why we want to keep those records is that if we need to go back and try to find a mistake or try to find an account, we'll want these references so that we don't just have to dig through all of our accounting records. We can go back to, say if our cash account didn't balance at the end of the month, we could just go back to any transaction that happened in the cash account and identify, did we miss one? Did we accidentally credit when we should have debited? So in double entry accounting, we're going to identify the transaction, analyze the transaction using the accounting equation, record the transaction in a journal, and then post the entry. We're going to use T accounts in this class just for the purpose of simplicity. It's easier to see what's happening in a T account than it is in those balance column accounts.